Hi everyone, it's Jack back with another video, and today I'm going to be talking about Verizon stock. For those who don't know, it's one of the largest telecommunications companies in the world, the largest wireless carrier in the USA, with over 140 million subscribers, currently a $150 billion company, trading at a trailing price to earnings ratio of around 7. I'm really interested in its 7% dividend yield. It's essentially a utility company now. I believe telecommunications companies are key infrastructure providers and should be treated like utilities. Low single-digit revenue growth, nice dividend yield, returning capital to shareholders going forward and bringing their debt loads down. That's what I want to see from Verizon, and broadly that's what Verizon are trying to do. Counter to AT&T, which has a much worse debt load in my opinion, has made a number of questionable acquisitions. Verizon hasn't done so much of that. It still has a really bad debt load, but not done so much of that, and I believe it is a better prospective investment and also has a 7% dividend yield, which is excellent. Despite this, it's been a pretty poor stock to own over the last, pretty much any period inside the last 10 years. In the last 365 days, it's down almost 30%. In year to date, it's down around 10%, but I reckon there's a salvageable stock investment here. As you can see by looking at the top graph, Verizon stock over the last 10 years is essentially flat, albeit a bit of a roller coaster in between, with highs of around $50 in 2021 or $55 even. It's still essentially flat over the last 10 years, which is obviously subpar and losing significantly into the S&P 500. If you were an income investor in that time, you're probably pretty happy. Very little in terms of stock appreciation, but your dividend payout has increased dramatically, pretty much doubled in that time. And from a yield perspective, it has risen enormously. It's almost doubled. It's around 7% now. It was around 4% in 2013. That's mainly, essentially due to dividend increases, and then recently due to stock price depreciation. However, this is a business that is only spending around 50% or 55% of its free cash flow on its dividend. It's essentially a free cash flow printing machine, and it looks like it can keep this dividend up and continue it for the future. So this looks like a relatively safe 7% yielding business in my opinion. Valuation wise, especially compared to the index S&P 500, this business looks objectively cheap. Trailing price to earnings of around 7 is below its own 5-year average of around 11, and significantly below the S&P 500 trailing, which is around 20 right now. Of course, that is brought up by the 7 or 8 or so major tech stocks that are pulling this up. Price to cash flow currently less than 4, absolutely staggering. Has just declined over the last 5 years or so to the point where it is now. Relatively static free cash flow and decline in price has resulted in a price to trailing cash flow of around 4, which is truly undervalued in my opinion. Not many quality companies that you see with a cash flow like that. 5-year average is still low, under 6, but even then, a price to cash flow under 4 is terrifically undervalued in my opinion. Price forward earnings around 7.7, so they're predicting a slight decrease in earnings per share going forward. PEG ratio of 6, there's not much growth expected here at all, but that earnings yield right now is absolutely enormous at around 14%. That's double what it was in 2017, and that's the highest it's been in the last 5 years for this business. That is truly excellent. Not many earnings yields you see over 14% unless a business is truly distressed and it is likely to go out of profitability soon, and they're looking at trailing numbers. But a 14% earnings yield for a company that is relatively static in terms of earnings and cash flow is really impressive. The compound annual growth rate for this business's revenue numbers the last 10 years is about 2%. Not overly impressive by any means. This is a utility-like business in my opinion, heavy infrastructure provider. It was $120 billion of revenue there or thereabouts 10 years ago. It's now $136 billion. It's never going to blow the doors off with revenue. I think these type of businesses should be treated like utilities. You can see over the last 10 years the year-end revenue numbers, and on either end they're not particularly large. 2016 down 4%, in 2014 down 5%. That's the minimum and maximum. We're not going to see big changes here, and that's just what you like from an income play. And that's demonstrated by the most recent results. $32.9 billion in revenue, that's down 1.9% year over year. Total wireless service revenue was up 3% year over year, which is now the largest part of the business. Adjusted earnings per share were down 11.1% year over year, which is absolutely not what you want to see, and adjusted EBITDA was down 1.1%. Of course, these are variable businesses. They often have a lot of capex to spend on building infrastructure. The transition to 5G is obviously a very capex intensive move, these type of businesses, and that is often reflective in lumpy earnings per share. What is traditionally not lumpy is the dividends that seems to just increase as the years go on because they have enough free cash flow to pay it. But that remainder of the free cash flow that goes on capex generally is a bit all over the place and can go up and down depending on their infrastructure spend, and that's, I think, what we're seeing recently. Here's some operating metrics, and these are really a mixed bag here. Broadband net adds, really impressive. They had 437,000 customers in Q1, which is exactly what you want to see from this business, increasing its broadband net adds. However, consumer wireless retail postpaid phone net adds was down 263,000. Again, these are lumpy areas. There's a lot of competition in this area, but generally Verizon continues to have the largest market share in this space and is looking like continuing to do so. Business wireless was up 136,000. That was in absolute terms significantly down from Q1 2022, but not a loss. And again, in the spectrum of having 143 million wireless subscribers, this is not really moving the needle at all. Prepaid net adds down 351,000, but again, none of these are really moving the needle. Wireless retail postpaid gross adds was 2.4 million, up 5.3% year over year. Wireless retail postpaid consumer phone gross adds up 11.5% year over year. Wireless postpaid upgrades down 15.9% year over year. That's probably inflation and a bit of quantitative tightening from a household perspective reasoning. Not many people are going to be keen on doing upgrades in a tightening environment. The cash generation in the most recent quarter was absolutely excellent compared to last year. Cash flow from operations up significantly to 8.3 billion, up from 6.8 billion. Capital expenditure increased only slightly to around 6 billion from 5.8. Free cash flow was up over 100% to $2.3 billion from just $1 billion the year prior. Dividends paid out remained broadly in line, and total debt actually came down. 152 billion is a significant amount of debt, don't get me wrong. It's round about where its market cap is right now. This is not unusual for infrastructure companies like this. It's much better than AT&T's in my opinion, which is its closest competitor. This is not unusual. They have a lot of capital to spend. It's not, and it comes at lumpy times when the next generation of infrastructure is coming. Sometimes you need to pay an enormous amount on capital expenditure. In the past, this is not a well-managed company. I believe management has the debt load managed well, and they're going to continue to do so and manage it well. They don't have a lot of cash on the balance sheet, only around $2.2 billion. So they have a significant net debt position. I'm not overly concerned. This is a pretty much cash printing machine, producing around $8 billion of cash flow a year at the current rate. I'm not concerned whatsoever. Next, I thought I'd show you a DCF calculation that I've done. I tend to do these in the most conservative way possible. I'm predicting a revenue growth rate over the next 10 years of around 2%. Terminal stage growth rate of around 2%, because I don't really think this at any point in a growth stage. It's a mature company, it's going to probably grow between 0 and 3 or 4% forever, in my opinion. I'm using a discount rate of around 8% for the long-term returns of the stock market, and this gave, based on today's stock price, around $35, $36, roughly fair value. Don't think this is a bargain by any means, but based off these assumptions on its free cash flow, I believe that is roughly fair value. You may have noticed that the dividend was higher than the most recent cash flow numbers in the last few quarters. This is definitely something to watch with this business, but I do believe the dividend is sustainable going forward. Traditional payout ratios being between 50 and 60%. I'm not overly concerned because, as I mentioned, there are some lumpy capex numbers where suddenly capex will be $6 billion for the quarter. This is not every quarter by any means, so I'm not overly concerned about this. I think this is a reasonable income play. Again, some of the major concerns is the debt pile, 150 billion, that's roughly equal to market cap, is slightly concerning, and they will have to serve this debt going forward, but management seems to be doing a good job getting that under control. They're probably going to sell some of the assets over time. Cable is, of course, there is been a long trend with cable cutting over time. I think eventually this will even out. Not everyone's going to use streaming platforms all the time. There is still absolutely a need for cable in certain people's lives, so I think this will broadly even out as they increase the wireless ads over time. The cable ads will come down and it'll roughly even out. Still think this is a fantastic business, essentially a utility right now, paying a 7% dividend yield, which I believe is relatively safe going forward, and trading, in my opinion, at roughly fair value. So there's a decent amount of margin of safety here. I'm willing to start sprinkling a couple of shares into my portfolio. Of course, this is just my opinion. You should let me know what you think in the comments down below. Of course, I'm not a financial advisor, so you should not take any of this as financial advice. You should do your own research and due diligence. Capital is at risk when investing in any business or any stock at all. So do your own research and due diligence, or contact a registered financial advisor. Like and subscribe and enjoy the content. I'll see you again next time.